Imagine for a moment that you are not sitting in front of a trading screen, but scurrying across the cold stone floor of a massive warehouse. In the corners, piles of golden grain are stacked high, each kernel glimmering like the profits you dream about. You are quick, you are clever, and you think you know exactly which path will get you to the treasure before anyone else. But as you dart forward, a shadow passes across the floor. The cat is here. Its eyes glow, its claws flex, and you realize that every move you make is being watched, measured, and judged. This is trading. This is Wall Street, a never-ending game of cat and mouse. Steve Cohen, once hailed as the king of hedge funds, knew this game better than anyone. He could turn millions into billions with trades so fast and precise that the rest of the world could only gape in disbelief. Year after year, SAC Capital, his hedge fund, crushed the market with returns most traders could never imagine. But the faster the mouse runs, the sharper the cat's attention becomes. Behind Cohen's staggering success loomed questions, investigations, and the relentless pursuit of the FBI. The line between legal edge and illegal insider information blurred until it became almost invisible. Now pause. Write down your last losing trade. Got it? Because this isn't just his story, it's yours too. Every time you chase a hot tip, every time you enter a trade without a plan, you are the mouse. And the market, the regulators, and your own psychology are the cats. One misstep and you're caught. But what if there were rules, 10 survival strategies, that could turn you from prey into the mouse that always escapes, that always finds its way back to the safety of the burrow with grain in its paws? Welcome to Trading Psychology Stick, where we dissect the mental game that separates survivors from statistics. Quick disclaimer, nothing here is financial advice, just hard-earned lessons from the warehouse floor. We explore real stories, real losses, and real strategies that keep you trading tomorrow. In this video, I will take you through these 10 strategies, each one forged from real stories. Cohen's empire, Rajaratnam's whispers, Longueuil's midnight panic, smashing hard drives, Martoma's billion-dollar bet gone wrong. These are not fairy tales. They are scars carved into Wall Street's memory. And from each scar, we extract wisdom that you, as a trader, can use. So, buckle in. What you are about to discover is both exhilarating and unsettling. How to build an edge without stepping into the cat's jaws. How to measure it, protect it, and most importantly, keep it alive. You're about to learn how to live as a trader in a world where the cats never sleep. But first, a simple but dangerous question that most traders never truly answer. What exactly is an edge? And how do you know if the one you cling to isn't just an illusion? Chapter 1, The Mouse's Instinct. What is edge? What is an edge? Traders throw the word around as if it were a magic spell. I've got an edge. This is my edge. But pause for a moment. Strip away the bravado, the caffeine-fueled confidence, the quick screenshots of profit. What does it really mean? Imagine again the mouse in the warehouse. Every grain of wheat is a potential trade, but some grains are poisoned, some are traps, some are placed where the cat lurks in silence. The only way the mouse survives is by sensing something the others don't. That sense, that difference, that sliver of advantage between life and death is what we call edge. Steve Cohen built his legend on edge. In the 1990s, when hedge funds were sleepy tools for wealthy families to hedge against market chaos, he turned them into weapons. SAC Capital became the most feared name on the street. Year after year, while others stumbled, he returned 30, 40, even 60%. To outsiders, it looked like magic. To insiders, it looked like a mouse that always knew exactly where the cat wasn't looking. Here's the uncomfortable truth they don't tell you in trading courses. Edge doesn't come from luck or gut feeling. It comes from information, from structure, from a system that others don't have or don't dare to use. Picture Cohen's traders as dozens of little pods, each one hunting scraps of information. A doctor who whispers about a drug trial, a broker hinting at an upgrade, a consultant slipping details about quarterly sales. Each pod feeds back into the main brain, Cohen himself, who decides which scraps become a feast. That was his edge, a web so wide it caught rumors before they became headlines. But ask yourself, was it skill, or was it stepping too close to the cat's claws? The FBI thought the latter, and when the cat prowls close, even the fastest mouse begins to shake. Now turn the mirror on yourself. Have you ever convinced yourself you had an edge because you read a forum post before others? Or because your gut screamed buy when you saw a green candle? Did you call that intuition? Or maybe even genius? Stop right now. Pull up your trading journal. Can you write down your edge in one sentence? If you're struggling, comment below with what you think your edge is. Let's test it together. The wisdom bomb here cuts deep. An edge is not a feeling. It is not a story you tell yourself to justify a trade. An edge is a measurable difference between your probability of success and the market's randomness. If you cannot write it down, if you cannot test it, if you cannot explain it to another trader without blushing, then it is not an edge. It is a fantasy. And fantasies are how mice end up in traps. So ask yourself now, what is the one thing you know that you can prove that the crowd does not? Is it your ability to code and backtest? Is it your discipline to wait while others chase? Is it your process of gathering alt data from public sources while the herd scrolls Twitter blindly? That, and only that, can become an edge worth keeping. But here's where it gets dangerous. Knowing you have an edge is only half the battle. The other half is proving it with cold, hard math. Because if you cannot measure how fast you run, you will never know if you're truly outrunning the cat or simply sprinting in place. The mouse may believe it is fast, nimble, untouchable, but belief doesn't save it when the cat pounces. Only proof does. In trading, that proof is expectancy, the cold calculation of whether your edge is real or imagined. Expectancy is the stopwatch in the cat and mouse chase. It tells you, not in dreams, but in hard numbers, if you are outrunning danger or if every step is dragging you closer to the claws. Expectancy is simple to define, yet brutal to confront. It is the average amount you expect to win or lose per trade. The formula whispers its truth. Win rate times average win minus loss, rate times average loss. If the result is positive, you have a fighting chance. If negative, every trade is another step toward the cat's jaws. Steve Cohen's SAC knew this intimately. In the first 7 years of its reign, the fund had only 3 losing months. The worst was a decline of just 2%. While others flailed, Cohen's stopwatch kept perfect rhythm. He wasn't just fast, he could prove it, month after month, year after year. But let's not romanticize it. Expectancy doesn't care about your story, your dream, or the fire in your gut. It only cares about the math. Picture this: a trader who wins 60% of the time, but each loss is double the size of a win. Expectancy will tell you he is not clever, not special, but doomed. Another trader wins only 40% of the time, but his winners are 3 times his losers. Expectancy will whisper, "This mouse will live another day." Numbers do not lie. Traders do. Close your eyes for a moment and recall your last 20 trades. Do you remember why you entered? Do you know your average win, your average loss? Can you say without hesitation whether your expectancy is positive? Pause the video right now. Calculate it. I'll wait. Because if you cannot answer this, then you are not trading, you are gambling in the dark. And in that darkness, the cat sees you more clearly than you see yourself. Risk metrics are not a luxury. They are survival gear. Profit factor, which compares gross wins to gross losses, tells you how sharp your claws are. The Sharpe ratio, which measures return against volatility, tells you if your path is smooth or erratic. Maximum drawdown shows the depth of the hole you will fall into when luck turns against you. These are not academic ideas. They are the very wires of the trap you must avoid. Ignore them, and you will hear the cat's purr behind you sooner than you expect. Your challenge starts tonight. Take your last 100 trades, calculate the expectancy, face the truth. If the number is negative, you are running in circles, and the cat will eventually catch you. If positive, nurture it, protect it, refine it. Because a true edge is fragile, and one careless night in the warehouse can undo years of survival. But even with proof in hand, you need structure. The mouse that survives longest doesn't rely on one tunnel, one skill, one path. It builds a system of independent burrows, each serving a different purpose, so no single failure can destroy everything. Chapter 3. Multiple Tunnels, the Pod System. Every mouse knows a single tunnel is a death sentence. If the cat crouches at the only exit, the game is over. Survival demands multiple routes, hidden doors, a labyrinth of escape hatches. In trading, this is the essence of the pod system, breaking down your process into independent silos so no single mistake dooms the whole. At SAC Capital, Steve Cohen perfected this architecture. Instead of one massive team, he built dozens of pods. Each pod was like a burrow of mice, responsible for researching, analyzing, and proposing trades. They operated semi-independently, chasing scraps of information, digging for opportunities. But here was the genius. Cohen stood above them all, not as the one digging, but as the predator choosing which tunnel led to safety. When a pod uncovered something useful, Cohen could seize it, scale it, and if wrong, cut it loose without letting the poison seep through the whole organization. Imagine it. A pod of analysts whisper about a tech stock ahead of earnings. Another pod maps healthcare data. A third tracks macro flows. Each burrow works feverishly, chasing edge in their corner of the warehouse. Meanwhile, Cohen sits at the center, listening to the echoes, waiting for the one sound worth chasing. It was diversification of both information and risk, a structural advantage that allowed him to always have another tunnel when one collapsed. Now let's make this real for you. You may not run a billion-dollar fund, but you can still think in pods. Separate your roles: researcher, trader, risk manager. As a retail trader, maybe they all live in the same mind, but you must keep their voices distinct. When you research, you are the curious mouse sniffing for crumbs. When you execute, you are the hunter making swift decisions. When you manage risk, you are the cautious guardian who says no. If these roles blur, if you let the same voice chase, execute, and rationalize losses, you will fall into the cat's jaws without even realizing it. Here's your pod assignment. Create 3 separate documents tonight. One for research notes, one for trade execution rules, one for risk management limits. Never let them mix. When you're researching, you cannot trade. When you're trading, you cannot change risk rules. Comment pods ready when you've set this up. The wisdom bomb that saves accounts. Pods are not just organizational tools, they are psychological armor. They prevent bias from spreading. They stop hope from leaking into execution, fear from corrupting research, greed from crippling risk control. When you separate the tunnels, you make it harder for the cat to corner you. We've covered the foundation, what edge really is, how to measure it, and how to structure your mind in pods. These 3 concepts alone will change how you trade forever. But now we dive into execution, how to actually use these tools when the market moves. Chapter 4, Information Trading, From News to Probability. A mouse survives not only by running fast, but by listening. Every rustle of straw, every whisper of claws on the floor. Traders are no different. Markets hum with sound. News headlines, analyst notes, earnings releases, FDA approvals. But here is the paradox that will save your account. The sound itself doesn't matter. What matters is how you translate that noise into probability. In the early 2000s at the Galleon Group, Raj Rajaratnam received a phone call. Jefferies is going to upgrade Amazon in 6 minutes. 30 seconds later, after buying 100,000 shares, he made $500,000. To an outsider, this looks like sorcery. But to a trader, it is a vivid lesson. The difference between noise and signal is measured by time. Rajaratnam had minutes before the rest of the world learned what he already knew. That was his edge, but it was also his downfall. The FBI was listening, and the cat pounced. Now, picture yourself at your desk. A headline flashes. Company beats earnings. Your pulse jumps. Your mouse hand twitches. But stop. The sound you just heard is only raw vibration. What matters is your model of surprise. How much did the result differ from expectation? Was the market already pricing it in? Did option skew already signal the move? Steve Cohen's SAC made fortunes trading around events, not by guessing, but by preparing. They had 3 specific patterns. First, pre-positioning, slipping into trades just before the announcement when conviction was strong and risk well managed. Second, scalping the initial reaction, darting in and out like lightning to capture the chaos of the first minutes. Third, fading the overreaction, waiting for the crowd to exhaust itself and then running the other way. Here's an exercise that will change how you trade forever. Before you act on any news, ask yourself 3 questions and write the answers down. 1. What was the market expecting? 2. How different is reality from that expectation? 3. How do I structure a trade that benefits if my probability map is correct? Try this with the next headline you see. Share your analysis in the comments. The wisdom bomb cuts through the noise. Information itself is worthless. Interpretation is everything. If you act on raw news, you are no better than a mouse chasing every creak of the warehouse. But if you know how to assign probabilities, You become the mouse who hears the pattern of the cat's steps and knows which way to sprint. Markets reward not bravery, but choreography. Event trading is a dance with chaos, and if you improvise in the wrong rhythm, you will stumble into the cat's waiting jaws. The only way to survive is to systematize reflex. If this, then that. Scripts written in advance, executed without hesitation. But not all information is created equal. Some whispers come from forbidden sources, cheese that glitters too perfectly to be real. And the mouse that cannot tell the difference between clean data and poison bait will not survive long. Chapter 5. Clean Edge, alt data versus poison cheese. In every warehouse, the cheese glitters. Some pieces lie openly on the floor, scattered by chance. Others are placed with intention, gleaming in the half-light, too perfect to resist. But the mouse who lunges without caution soon feels the steel snap of the trap. On Wall Street, that cheese is insider whispers, tips about upgrades, trial results, quarterly numbers passed from lips not meant to speak. For years, traders called it edge. For years, it paid. Until the cats arrived with wiretaps and subpoenas, and the same cheese that fed them became poison that destroyed them. At SAC Capital, stories abounded of exorbitant commissions paid to brokers just for a first call. Imagine a trader wired into the veins of the street, hearing whispers before anyone else. Upgrade in 5 minutes. FDA approval coming. The quarter looks ugly. These were crumbs of cheese scattered by human mouths, and they fattened accounts until the FBI knocked at the door. In 2011, Steve Cohen himself sat for 2 days of deposition. When asked about Rule 10b-1, the SEC's primary weapon against insider trading, his answer stunned the world. No, not. You would have to explain it to me. Every hedge fund manager knows this rule, or pretends to. Yet Cohen shrugged it off as vague. To some, this was cunning insulation. To others, it was arrogance. Matthew Martoma bet SAC's fortune on Alzheimer's drug trials. For months, he built a massive long position. Then came the whisper from a doctor that results would be disastrous. Martoma flipped the book, shorting with ferocity. SAC made $275 million. Martoma was later convicted of insider trading. His compliance handbook, non-existent. He bet his life on poison cheese. So here's the paradox every modern trader must solve. You need an edge, but if you chase forbidden cheese, you die. What then is the answer? Alt data. In today's markets, the richest edges are found not in whispers, but in the noise of the world itself. Google search trends foreshadow demand spikes. Twitter sentiment shifts ahead of price action. Satellite images count cars in parking lots before earnings. On-chain data reveals liquidity flows invisible to casual eyes. This is cheese scattered freely, hidden in plain sight. Let me give you 3 alt data sources you can start using tonight. Completely free and completely legal. First, Google Trends for product demand. Second, Reddit sentiment scrapers for retail mood. Third, on-chain analytics for crypto flows. Pick one, master it this week, then add another. Share which one you're starting with below. The wisdom bomb here democratizes everything. Alt data levels the playing field. No FBI will ever knock on your door because you studied Google Trends. This is how the modern mouse survives, not by risking its neck for poison cheese, but by adapting to the ecosystem, turning scraps into sustenance. Your compliance challenge starts now. Create your own one-page compliance manual tonight. Not a thick book, just 3 rules. Rule 1, I do not trade on material non-public information. Rule 2, I log my sources. Rule 3, I can prove every trade is based on data in the public domain. Screenshot it, keep it visible. Type compliant below when done. Because the cat doesn't need to outrun you, it only needs to prove you broke the rules. And it always has more time, more patience, more power. Your survival depends not on speed, but on discipline. But even clean data won't save you if you bet too much on any single trade. The mouse that survives knows how to size its risks, how to run with the herd when necessary, and most importantly, how to ensure one loss doesn't end everything. Chapter 6, Risk Parity, Survival of the Colony. In the warehouse, a lone mouse darting across open floor is an easy meal, but a dozen mice scattering in different directions overwhelm the cat. Some may fall, but the herd survives. Trading is no different. Risk parity, the art of balancing how much you place on each trade, each strategy, each path. is the difference between extinction and survival. Many traders believe conviction equals size. I feel it, therefore I bet big. But feelings don't save you when the claws swipe. Math does. SAC traders, for all their aggression, still understood this principle. Their pods operated independently, spreading risk across sectors and ideas. If one pod collapsed, the fund survived. Now imagine yourself staring at a chart. Your heart whispers, "This is the one. Go all in." The fantasy of doubling your account in a single trade tickles your mind. But pause. Kelly's criterion, the mathematics of optimal bet sizing, tells another story. Bet too much, and even with a positive edge, you will be ruined. Bet too little, and your edge goes wasted. Here's the formula that will save your account. Never risk more than Kelly percentage equals edge divided by odds. If your edge is 20% and odds are even, never risk more than 20% of capital. But here's the secret. Use fractional Kelly, usually 1/4, so that 20% becomes 5% max risk. Not exciting, but you'll still be here next year. The wisdom bomb that separates professionals from gamblers. Risk management is not about avoiding losses. It is about ensuring you are still alive after them. ATR sizing, fractional Kelly, portfolio level risk parity, these are the tunnels dug in advance, the routes that ensure one claw swipe does not end the game. Hold up the mirror and count the cost. How many times have you over-leveraged because you knew the move was coming? Every trader carries scars from betting too much. The difference between those who learn and those who vanish is simple. One writes new rules, the other repeats the same sprint into open space. So remember, conviction is not measured by size, survival is. The cat is always faster. Your only chance is to make sure you are not the one exposed when the paw comes down. Let's pause for breath. 6 chapters in, we've built the technical foundation. Edge, measurement, structure, information processing, clean data, and risk sizing. These are the bones of survival. But now we turn to the mind, because even perfect systems fail when psychology cracks. And the first crack always starts with the same poison. FOMO. Chapter 7. The biggest trap, FOMO. The most dangerous cheese is not the one set in a trap by others. It is the cheese your own mind invents. FOMO, the fear of missing out, glows brighter than any bait the cat could place. It whispers in the trader's ear, "If you don't grab this now, someone else will. If you don't jump, you'll starve." And countless mice have died chasing this illusion, sprinting headlong into claws that were waiting all along. Picture a retail trader sitting at his desk, charts exploding in green, Bitcoin rockets, a biotech stock doubles, social media buzzes with stories of overnight millionaires. His pulse hammers in his chest. He knows he should wait, knows the risk is high, but his hand moves anyway. He buys the top. Within hours, the market reverses, clawing back his capital with merciless precision. The cheese he thought was his salvation was just bait in a perfectly placed trap. Even SAC traders were not immune. Pods with weeks of research would crumble when FOMO infected them. An analyst, convinced a stock had to keep running, would size up recklessly, forgetting the playbook. One swipe, and their edge vanished. The cat doesn't need to be clever when greed does the work. This is the moment of truth. Think about your worst FOMO trade, the one that still stings. Write it down right now. How much did it cost you? Not just in money, but in confidence, in sleep, in trust in yourself. Share the number below if you're brave enough. Because acknowledging the wound is the first step to healing it. Here's the wisdom bomb. FOMO is not an external force. It is a virus of the mind, and the cure is structure. 4 simple steps can save a career. 1. Define your entry criteria before the market tempts you. 2. Write down your maximum size and never exceed it. 3. Commit to waiting for confirmation, even if it means watching the move without you. 4. Log every impulse you resisted as proudly as every trade you executed. Imagine the mouse who sees another dart across the floor to grab a crumb. The first mouse hesitates, watches, breathes. The cat pounces, and the bold, reckless one is gone. The survivor is not the bravest, not the fastest, but the one who knows that missing one crumb is better than losing his life. So engrave this in your mind. Missing out will not kill you. Acting on fear will. FOMO is the deadliest bait because it feels like your own desire, not someone else's trap. But once you see it clearly, once you refuse to run, you take back power. But knowing the trap isn't enough. You need a way to break free when you feel its pull. And that requires learning to interrupt your own patterns, to pause when every instinct screams to sprint. Chapter 8. Breaking the Loop, Pattern, Interrupt, and Curiosity. In the dead of night, when the warehouse is still, a mouse pauses. Its whiskers twitch, its chest rises and falls in short bursts. It listens. Not moving is sometimes the only way to survive, because if it runs blindly at every sound, sooner or later, it sprints right into the cat's jaws. Traders, too, must learn this pause, the art of interrupting their own patterns before fear or greed drives them to ruin. The markets lure you into rhythm, screen glowing, charts ticking, your hand hovering over the mouse. Buy, sell, win, lose, repeat. The cycle feels hypnotic. Until one day, you realize you're not trading anymore. You're reacting like prey trapped in a loop. Consider the story of Turney Duff, a hedge fund trader who described the intoxicating life of chasing information. Nights blurred into mornings, clubs into boardrooms, whispers into trades. The rhythm was intoxicating, unstoppable, until the FBI's wiretaps ended it. His downfall wasn't just the whispers, it was his inability to stop, to pause, to question his own loop. Now imagine yourself. You've lost 3 trades in a row. Your instinct screams, one more, make it back. Your pulse quickens, the pattern tightens around you. This is the cat's rhythm, not yours. Here's your pattern interrupt toolkit. When you feel the loop tightening, stand up physically. Walk away from the screen. Ask yourself out loud, if this was my first trade of the day, would I take it? That single breath, that physical movement, can save you from disaster. Try it tomorrow. When you feel compulsion rising, interrupt the pattern. Then come back and tell us what happened. The wisdom bomb is counterintuitive but true. Curiosity kills the cat. Not literally, but figuratively. When you are curious instead of compulsive, the cat cannot predict your moves. Markets feast on predictable prey. They punish the trader who always doubles down, always chases, always panics. But the trader who breaks the pattern, who surprises even himself, becomes far harder to catch. Pattern interrupt is not weakness, it is strength. The mouse that pauses mid-run lives longer than the one that bolts into every corner. The trader who breathes, questions, and waits writes a very different story than the one who chases every flicker. But sometimes, even with all these tools, fear overwhelms everything. And in those moments of pure terror, traders do something even more destructive than chasing or freezing. They destroy their own evidence, their own learning, their own chance at redemption. This is the story that haunts every trader who's ever panicked. Chapter 9. The Dark Night, when panic destroys everything. There are moments when the warehouse is silent, too silent. The mouse freezes, whiskers trembling, because silence means the cat is near. And when fear reaches its peak, instinct takes over. Some mice run, others hide, but the most desperate destroy their own trails, clawing at the floorboards as if erasing their scent could save them. In November 2010, Donald Longueuil, once a rising star at SAC Capital, read an article that sent his world into shadow. The Wall Street Journal had just exposed the government's years-long investigation into insider trading, and SAC's name appeared in black and white. Longueuil panicked. He knew the cat was not just near, it was already in the room. That night, under the cover of darkness, he pulled apart his computer hard drives. With a hammer, he shattered them into jagged fragments, each shard a piece of his trading life, each fragment a confession in metal. Then, carrying 4 little bags of wreckage, he walked the city streets, 20 blocks, scattering evidence into random garbage trucks, praying the cat would lose his scent. But cats are not so easily fooled. The FBI had recordings of his conversations. His panic was too late. Longueuil and his colleague Noah Freeman were caught on tape, voices trembling, discussing their crimes. The mouse had destroyed his burrow, but the paw still came down. Eventually, both pled guilty. Stop and feel this moment. A successful trader, hammer in hand, destroying his own tools at midnight. This is where breaking rules leads, not to wealth, but to walking city streets with bags of shattered dreams. Have you ever felt that panic, that urge to hide your mistakes? Comment never again, if you're committed to trading clean. In 2013, the broader reckoning came. The U.S. government declared SAC Capital itself a magnet for market cheaters, and leveled the largest insider trading fine in history, $1.8 billion. The tunnels collapsed. The cat had sprung its trap. SAC agreed to shut down as a hedge fund, forced to return client capital, its name forever stained. But Cohen himself was never criminally charged. The cat's paw struck the colony, but the king mouse slipped through. He emerged wounded yet alive, barred temporarily from managing outside money, but still one of the wealthiest men in America. The empire he built, the culture of whispers and edge at any cost, was gone. Here lies the wisdom bomb that most never grasp. Fear will make a trader destroy himself faster than any market or regulator ever could. Longueuil did not lose because of a bad trade. He lost because of panic. Traders do the same every day, deleting journals, ignoring losses, hiding from reality. They smash the very evidence that could save them, because facing the truth feels worse than the claws. The cat does not need to kill you. It only needs to scare you into killing yourself. The lesson of Longueuil is not about legality. It is about psychology. The mouse who destroys his own tunnels dies without the cat ever lifting a paw. But there is a way forward, because survival is not about avoiding fear. It's about building systems so robust that even in panic, the right actions become automatic. And that starts with the most important ritual of all, the nightly review that turns every scar into wisdom. Chapter 10, The Survival System, Pipeline and Nightly Ritual. The mouse that survives longest is not the one that runs fastest, but the one that builds a system of tunnels so complete that no matter where the cat pounces, an exit is always near. And when the warehouse grows quiet, when the cat retreats, this mouse doesn't celebrate. It returns to the burrow and begins its ritual. It traces the paths it ran, the near misses, the traps avoided, the crumbs found, because tomorrow the game begins again. For traders, this dual system, the automation pipeline for testing ideas and the nightly ritual for learning from experience, is not optional. It is oxygen. Without it, even the best edge dies from neglect. First, the pipeline. At SAC Capital, ideas were gathered, filtered, tested in small size, then scaled only if proven. It was not luck that kept Cohen's empire alive for so long. It was process. Now, imagine yourself. You read a new indicator, hear a new strategy, stumble across a new data set. Do you rush to market with it, or do you feed it into your pipeline? Let me give you the 5-step pipeline that turns ideas into edge. Step 1, idea capture, write it down. Step 2, backtest. Test across hundreds of trades, dozens of markets, years of history. Step 3, paper trade, let it run in shadow, earning no cheese but proving its rhythm. Step 4, micro-size live, risk pennies to test real execution. Step 5, scale only when metrics prove expectancy positive. Which step do you usually skip? Be honest in the comments. The wisdom bomb. Without a pipeline, even good ideas kill you. The market doesn't punish only bad trades, it punishes reckless scaling. The mouse who builds one tunnel and sprints through it is doomed when the cat learns its pattern. The mouse who builds a network lives to eat another day. Now, the nightly ritual. Steve Cohen demanded daily P&L reviews, performance breakdowns, forensic analysis of what worked and what didn't. Each pod submitted notes, feedback loops tightening around every mistake. It was not romance, it was cold survival. Picture yourself. The market has closed. Your trades are over. Do you shut down the screen and escape into distraction? Or do you pause, breathe, and document? Here's the nightly ritual that will transform your trading. Every night, answer these 5 questions in writing. What was my best trade today and why? What was my worst trade and what triggered it? Did I follow my rules or break them? What pattern did the market show that I missed? What will I do differently tomorrow? Start tonight. Post your answer to question 1 below. The True Survivor's Journal with brutal honesty. Entry reason, exit reason, risk sizing, emotions felt, rules kept, rules broken. They do not wait until the pain has faded. They press their finger into the wound while it still burns, engraving the lesson so it cannot be forgotten. Rituals turn chaos into pattern, and pattern into growth. They transform mistakes from silent killers into stepping stones. They make you the mouse that not only survives, but thrives, because every chase adds to your map of the warehouse. The cat does not change. It will always be faster, stronger, patient. But you change. You grow. You see the traps before they spring. So, tonight when the charts are dark and the silence of the warehouse creeps in, begin your ritual. Write down every move, every thought, every scar. Because tomorrow, the chase begins anew. And when it does, you will not just be another mouse. You will be the one who knows every corner, every shadow, every path. And that is the ultimate lesson. Trading is not about escaping once or even 100 times. It is about building a life where the chase itself becomes your training ground, where every night you survive makes you sharper for the next. You've followed the mouse through every tunnel, every shadow, every brush with the cat's claws. 10 lessons carved into story, each one a survival code for traders who refuse to be prey. You learned what edge really is, not fantasy, but measurable advantage. You learned how to test it with expectancy. You discovered the pod system for separating roles. You learned to turn information into probability, not panic. You saw the difference between clean alt data and poisoned insider cheese. You understood risk parity, why the herd survives longer than the lone gambler. You felt the lure of FOMO and learned to resist it. You mastered pattern interrupts to break compulsive loops. You lived through Longueuil's midnight terror and SAC's billion-dollar collapse. And you built your survival system, the pipeline for ideas and the nightly ritual for wisdom. 10 chapters, one truth, the cat never sleeps. But neither does your chance to adapt. Now, here's your first assignment. Tonight, before you sleep, write down the one lesson from this video that hit you hardest. The one that made you pause, made you think, that's me, that's my weakness. Share it in the comments, not for me, but for yourself, and for every other trader reading who needs to know they're not alone in this warehouse. This channel, Trading Psychology Stick, isn't just a voice telling stories. It's a colony, a tribe of traders learning to survive together. Every comment you leave, every story you share, becomes a signpost for another mouse trying to find their way. Your scar might be someone else's salvation. So, hit that subscribe button, not because I asked, but because you've decided you're done being prey. You're ready to be the mouse that learns, that adapts, that survives. And survival is easier when we map the warehouse together. Before you go, one final challenge. Tomorrow, when the market opens, when your screen lights up and the chase begins again, remember this. You now have 10 ways to survive that you didn't have an hour ago. Use just one. Pick the lesson that scared you most and apply it. Then come back and tell us what happened. Remember this one line as you leave. Trading isn't about beating the cat once. It's about becoming the mouse that learns faster every single night. That's your edge. That's your freedom. And that's why you're here. The warehouse doors are closing now. The cat sleeps, but only briefly. Tomorrow it hunts again. And tomorrow you'll be ready. Welcome to the colony. Welcome to survival. Welcome to Trading Psychology Stick. See you in the next video, where we'll dive deeper into the mind games markets play and the mental models that keep you alive when everyone else is panicking. Until then, stay sharp, stay humble, and most importantly, stay alive.